Tax implications and considerations when buying or selling property. 1. Property taxes and their impact on ownership. Local property tax. Local property tax is an annual self-assessed tax payable by owners of residential property. It's based on the market value of the property at the most recent valuation date, and it's payable by the owner as of the 1st of November in the previous year. So the 1st of November, the registered owner at that point is the person liable for local property tax. Local property tax amounts are relatively modest compared to other ownership costs. Unpaid local property tax can cause issues on sale, as it is a charge on the property and must be cleared before completion. A local property tax would always, or generally, nearly always, be apportioned on closing between the purchaser and the seller. Commercial rates, on the other hand, relate to commercial properties, and they are the annual local authority charges on commercial properties. They are payable by the occupier, not the owner, unless the property is vacant. Then usually the owner is liable. The impact, obviously commercial rates will affect the profitability for investors and owners of business premises. 2. Capital gains tax and its implications. Capital gains tax applies on the sale, transfer or disposal of property where the sale price exceeds the original purchase price after deducting allowable costs. The rate of capital gains tax is 33% on the net gain. Allowable deductions would include purchase and sale costs, including legal fees, stamp duty and so forth, and improvement costs, which are of capital in nature, not repairs. So improvement costs include capital expenditure on the premises but not repairs. Exemptions and reliefs then in relation to capital gains tax. There is principal private residence relief. That means that there's no capital gains tax on the sale of your main home if it has been your principal residence for the entire ownership period and not used for business or rental purposes. There's also a small disposal exemption. Gains of up to €1,270 per year are tax-free, and there are specific reliefs then in capital gains tax. For example, a farm restructuring relief. I think there's a retirement relief. There's certain compulsory purchase reliefs. The impact of capital gains tax, it can significantly reduce net sales proceeds, particularly for investment or second properties. Remember, the principal private residence is exempt. Number 3, other relevant tax consideration for property owners. Stamp duty, it's payable on the purchase of the property. The rate of stamp duty on the residential is 1% on the first €1 million of the purchase price and 2% on the balance. Non-residential, including commercial land, including sites, the rate of stamp duty is 7.5%, and obviously you must be prepared to budget for these outlays at the outset, as is payable within strict timelines post-completion. Income tax is another tax you need to consider when you have rental income. If the property is let, then rental income is taxable at your marginal rate plus universal social charge and PRSI after deducting allowable expenses. Allowable expenses will include repairs, insurance, mortgage interest relief for residential lettings. There's special regimes then, income tax regimes, in relation to vacant homes and rent a room relief. Value-added tax. New residential properties are usually exempt, but commercial property sales and certain development land transactions can attract VAT. The question of VAT on property, especially residential and or commercial property, can be complex, so you need to get tax advice in relation to this, unless it's absolutely clear that there is no VAT being charged in the transaction. Complex VAT rules can influence structuring of transactions, especially for developers and investors. Then you need to consider inheritance and gift tax. If a property is gifted or inherited, the recipient may pay capital acquisitions tax at 33% above certain thresholds, depending on their relationship to the donor. So the relationship to the donor is absolutely key, because a child, for example, of a donor will have a significant tax threshold up to €400,000, for example, as opposed to a brother or sister or a niece or nephew. So they are some taxes which affect property transactions and the acquisition and sale of property in Ireland. I hope you find the video useful. If you do, I would appreciate if you hit the thumbs up button down below. Thank you very much.